Good afternoon, everybody. My name is Ivor Price. I'm the editor-in-chief of VentureBin. It's an Africa-wide publication dedicated to tech startups. And I'm honored to lead this discussion. I know we've had a great lunch, and we have close to 2,000 people online. But if you're in the venue, I'm going to ask you just to settle down for a few seconds so we can get into this interesting discussion. So this afternoon, we'll delve into the evolving landscape of green economy innovation funding, and we'll specifically explore the recent shift in the balance between equity and debt financing. It's a trend that caught the attention of investors and entrepreneurs alike. And without further ado, I'll introduce my panel. Next to me is David Saunders. He's the Director of Strategy and Growth at Brighter Bridges. He specializes in knowledge infrastructure for underserved markets, holds a BA in economics from Furman University in South Carolina. You've spent half of your life working in informal markets. And he's a fellow Cape Townian, even though you might hear that he's got a bit of an American accent. I don't know if you identify as South African yet. Sebastian Wichman is Regional Head of Africa at Lendable, focused on impact-driven fintechs. He holds an LLB from the School of Oriental and African Studies at the University of London. Great having you, Sebastian. Joshua, right there, Romisher is the CEO of Holocene Ventures, dedicated to climate tech startups, sustainable investment. He holds a master's degree from Stanford Graduate School of Business, and he's a CFA charter holder. And then, of course, Hetal Patel, who's the director of Mercy Corp's Ventures. Josh, maybe we start with you, just to set the stage. Perhaps you could just define both equity and debt financing, and also just discuss their roles in funding innovation. So we have a similar definition before we kickstart the conversation.
Yeah, great. Thanks so much. And thanks, panelists, for coming up today. And it's always fun to be part of the after lunch crew. So thanks, everyone, for listening a little bit. I will say, if you are listening and you're here, this is a hypercritical, important discussion to be had for climate tech. I want to make it clear that fintech, property tech, and other types of startups are very different than climate tech. Climate tech, for one, which I've been in for about 10 years, is really hard to build. It's really hard to get it to market, and it does require a very sophisticated and blended financing approach. So today we're talking about debt and equity, but I'd argue that we also need to include grant capital, and we need to include human capital into this discussion, if not things like carbon finance, carbon credits, and the like. So the overall financing of climate tech is complicated, but it also can be a massive competitive advantage for your startup. So if you're an investor sitting here today thinking about, okay, I do equity, how do I think about grants and debt? If I'm a grant funder, how do I think about equity and debt? If I'm a startup, how do I think about my capital structure as I'm starting to get some traction, as I'm starting to get some customers, and then as I'm starting to scale? Because that mix of grant, human, debt, and equity is hypercritical to building a climate tech company that can scale, that can be viable, and that can, frankly, attract capital from great investors like the ones up here and the ones in the room.
So, David, maybe to further frame the discussion, I know you've studied the current state of clean tech in Africa. You've got some fresh analysis on it, and maybe you could elaborate on the observed inversion between debt and equity funding in the recent year.
Yeah, thanks so much, Ivor. And Hetal reminded me before I got on this stage that we're actually not an investor, and what are we actually doing up here? The answer is that I think we're providing some data, and when we actually started looking into this question for this panel, we were very, very surprised, actually, because I think there's been a lot of talk about debt this year, the role that debt can potentially have in financing innovation, and I didn't think we were expecting to see such a big inversion. So first, just in terms of clean tech, I mean, I think everybody's here because it's Africa Climate Week. This is an increasing focus in the continent, but the numbers are also seeing a bit of a pivoting around clean tech and climate tech in particular. So we just released our H1 report from Brighter Bridges, where we actually saw that the biggest increase in funding from H1 2022 to H1 2023 was in clean tech. It grew from over $400 million to over $500 million. So, this is at the same time when we're starting to see a bit of a decrease in other sectors. One that's really led the way over the last decade was fintech. That fell from $1.2 billion to over $800 million. So it's still leading the way. It's still a big player, but we are starting to see that subtle shift. And I think we're increasingly seeing more and more funders, more and more types of investors getting interested in this space. So then what we said is, okay, so where is this funding coming from? We're all aware that it's been a pretty tough year. And I think what we were super surprised by was how much of a role debt is playing. So debt accounted for 80% of that funding to clean tech startups this year, compared to 20% of equity. That's a complete inversion from last year, where we saw 70% of the funding into clean tech from equity and 30% from debt. And we've even seen this showing up in the number of deals as well. So the number of equity deals in clean tech fell from 44 to 16. That's just, that's quite a big drop-off we've seen. We're only halfway through the year, so hopefully we'll see some more funding in the remainder. But debt's actually already increased. So we're seeing more debt deals by this time this year than we saw all of last year. But as we were prepping yesterday, Seb asked me to look a little bit more into this because he thought that this was maybe missing one of the major stories here, which that this is really being driven by a very small number of deals. 75% of that funding went into 2 mega deals in solar energy, NCOPA and SunKing. And a big part of this was their ability to leverage the existing equity, the existing strength that they had from 2022. So I'm not really clear what we're seeing, and I'm very interested with these 3 expert investors taking different roles into it to help us make sense of what's happening in the space.
Sebastian, what's your take on it? What's driving it? And have you also noticed this inversion?
Yeah. Thanks, Ivor. Thanks, also, for having me. I hope everybody can hear me. Yeah.
My voice, I'm very loud.
Hey, yeah, that's much better. Yeah, first of all, by way of background, of course, Lendable is a private debt fund and advisory business that focuses on growing fintechs in emerging markets. Since 2016, we've deployed about north of $400 million to fintechs. And here probably is a representative of the debt investment industry on this panel. So yeah, first of all, I guess, as you already mentioned, I think the data from earlier this year is obviously heavily skewed because of those 2 major deals to SunKing and NCOPA, which were $330 million. But yeah, I mean, taking a step back again, just Josh, when we're talking about debt, for funding innovation, I think as a debt investor in general, and I think these NCOPA and SunKing deals also show that, is that as a debt investor, you want to see track record, you want to see cash flows that you can understand, the type of transaction. And of course, this has taken a long time for the pay-as-you-go industry as well to develop. I mean, they've been, many of these companies started in the early 2010s, and it took them till 2015, 2016 to have any type of sizable facilities, because debt is not naturally the form of capital that you look for when you're thinking about innovation. Debt investors are risk averse. We want to see track record. But of course, once you've actually developed a successful product, can show positive unit economics, etc., then of course debt is very useful to scale the innovative product. And yeah, so of course, these 2 transactions show that the market is very familiar with receivables-backed financing, which is a very similar structure to what you have in the fintech space, but is not necessarily a solution for every business in the climate tech space.
So, Hetal, moments ago when we were chatting offline, you mentioned that a balance was needed between equity and debt financing. And I'm wondering if you have practical examples of how this balance has played out in scaling up sustainable businesses in your portfolio.
We're getting to, can you hear me? Okay, yeah, we're getting to practical examples where people are able to start unlocking some debt to be able to test, especially when you're talking about testing new products or markets. without taking on what equity, which is quite expensive, and founders at a certain point don't necessarily want to take it on that early. But I'm going to take a step back. One, I fully agree. I think we need a lot more robust debt and grant market. Then we need the grant givers, if you're out there and hopefully listening, to update your game a bit and understand how and what to deploy and how quickly to deploy. I'm speaking from the founders, all right, who are here, so please don't punish me. But I think we need to all kind of update our game for climate tech. I will agree with this very esteemed gentleman from my left, or disagree, sorry, a little bit, that I think climate tech and deep climate tech are going to be difficult. And I'm kind of on this tear lately that we have to be realistic to the founders about what can be built when we are not built the infrastructure around it. There are no exit markets right now. So it's hard to have a lot of it. We don't have the track record, so we need to find grant givers or others who are going to take on debt at a higher risk, right, before they can get to 7 lendable. We need other pieces in terms of technology or research, which are not here yet. So when we start expecting deep tech, what do we really mean? Versus, and I think we should strive for it. I would invest in it. If you show me something tomorrow, I'll take it. And I'd love to be in a cool business model, but I think we also have to be really honest with, so what does it mean then when we're talking about climate tech? How do we think about it in food systems, which is going to be a big piece of a climate solution on the continent? How do we think about it in other climate smart or precision solutions, let's say in agriculture? I don't know where Amira is, but she just wowed me earlier today because they're doing precision ag and irrigation. But in the end, again, self-admit, the first 3 years, they're working with research institutions in France and others to test it out. So I think we have to be realistic to the founders, else we're putting all the risk on them. It's like we did 10 years ago with smallholder farmers and saying that, you take the loans and there's nothing else there, and then why aren't you profitable? It's like, I think this is up to the ecosystem to kind of step up their game.
A challenge there, Josh, for us to level up. It's clear that debt plays quite a significant role, particularly in the later stages. Maybe your feedback on what you've heard so far?
Yeah, no, I think it's a great comment. I think it's super important to break down climate tech into different spaces as well, right? So, for instance, we have Wild Bio here today. So Paul is doing deep tech. He's trying to build an immortalized cell line and cultivated meat from rare, unique African species. That's deep. That is like Global North, lots of funding sort of thing. You have Jesse from Mozi Mobility right here, being my cameraman for a second. Thank you, Jesse. Who's building e-mobility in Kenya. So again, asset heavy, funding a boda driver. So you B2C, rural, low income, asset heavy, tough business model. And then if we had Zimmy, so Zimmy is one of our investments down in South Africa, which is more B2B, commercial, urban, a little bit of hardware, a lot of software. It looks more like Europe to a certain point, like the way you would think of that business model. So even within climate tech, now we have 3 very different types of funding needs, time to get to market, time to sell something, ability to raise debt. So it's super important to get out of climate tech and to start getting into the granularity of different business models and how we utilize certain types of capital for those business models.
Do you want to respond, Sebastian?
Yeah, of course, because I think these are 2 very important points made. I think one, I want to make a point about Lendable and what we're trying to do as well about this, but one is that in any case, we need more early stage kind of like grant or concessional funding, and also I think probably support from DFIs as well, which have been very focused on actually commercial opportunities rather than actually funding kind of high risk parts of the ecosystem. But yeah, beyond that, of course, again, just to add to what you guys have said as well, is if we're looking globally as well, and we're looking at climate finance, the majority of climate finance today is just green bonds from corporates, or VC for kind of tech businesses. But there's a huge opportunity, of course, for SMEs, mid-market enterprises, etc., that don't have access to capital to actually make this transition, to adopt clean technologies, etc. So this is where the massive missing middle again is in climate finance as well. And this is something that we want to address at Lendable, and that's why we've launched a $200 million decarbonization fund, focused on emerging markets, focused on the 3 sectors that will, are the most polluting, which will be mobility, energy, and food systems, and to provide sustainability-linked loans to these companies where we have pre-agreed incentives and we'll have, interest rate step-downs, etc. But also, probably a quarter to half of it will have some element of carbon credit project associated with it as well. And that will be our part. It still doesn't solve the question for the early stage, which I think, you know, equity and grant, etc., have a big role to play.
Do you want to respond? Or can I go? Yeah. So I've had quite a number of conversations with some of the startup founders in the room, and I'm wondering, David, if there isn't some sort of a gap in financing new and innovative clean tech products that maybe require different support compared to fintech.
Yeah, and I think this is a little bit of what Josh and Seb and Hetal have been getting at as well. I mean, we took a walk with Jesse. I also took a walk with Jesse yesterday. So Jesse, you're famous. You're basically part of this panel, I feel. But he was explaining to us the limited opportunities that you have for debt financing at the early stage. And I think in a business like himself, where he already has assets, some of the opportunities he actually has for debt financing aren't that attractive to him. And it often forces you to take potential other type of funding, like from equity at that stage, which might not also be that attractive. So it puts a lot of pressure, I think, on grants, which is what we've been speaking up here, to come and address that space. And I think a little bit of what maybe we want to see and what Lendable is also looking at is how can they address a little bit more at that kind of early stage or that missing middle that can help businesses that already have a few assets that they can leverage to get more financing without having to take that next step to taking equity. And I also think one of the interesting things that Josh was also getting at is, you know, asset-heavy businesses require different types of financing, and where it doesn't mean, though, that all climate tech businesses are asset-heavy. There are some interesting climate tech businesses like Sun Culture in South Africa, which more is like a crowdsourcing platform to finance solar energy. I went to a launch event of a company I heard about for the first time, Sync, last night, that is doing some complicated thing that I don't understand with distributed ledger technology and carbon credits. But I think, you know, the point that we're seeing a lot of is being able to differentiate between the type of product that you have and the right type of capital stack for that. And I think this is getting really, really interesting, and is also asking us to crowd in a wider set of funders. And I think, Seb, to your point, also consider a wider set of businesses too.
So Sebastian, if I can stick with you for a moment, I think it's important to color it in with practical examples. Have you seen early stage clean tech startups navigate this financing gap successfully that we're talking about?
Yeah, I mean, look, I think there are good examples. I mean, we're based here in Nairobi. I mean, we have plenty of examples of companies that have navigated this. I don't think it's easy. And at the same time, I think it has been heavily reliant on actually their equity investors who have continuously supported these businesses over more than a decade. And again, I don't think every business can actually achieve that. I think from my point of view, of course, as a debt provider, I always think there should be a bit more emphasis on being commercial, controlling cost, etc., and having more sensible commercial approach to your business. But yeah, I think, look, I think in this, particularly in the African context, it's always a combination of all of the above, really. I think, I mean, I'm very happy to see that, for example, the debt landscape has changed a lot over the past 5 years that I've been at Lendable. I've seen the Kenyan startup ecosystem since 2010 develop a lot. So I'm very, yeah, I think there's plenty of examples. I mean, we have them here in Nairobi, you know, so I'm sure Hetal has some good examples as well.
Would you like to share it all? I know you've got a specific interest in adaptive ag, food systems, climate smart solutions, inclusive fintech. Yeah,
I mean, you know, we have a couple of portfolio companies that just actually secured debt from DFIs that is not concessionary, but cheaper, and that will let them test new markets and be able to really test kind of another level of technology. I do think that the gap that I'm seeing more is not when you get to that stage, it's still the earlier stage, like Seth was just saying. And I think there, the capital providers are not as nimble as we needed, grant or debt. And I think for different reasons, we can understand that for debt, they may not see enough track record, et cetera. So then what's the solution? We have to have an open conversation on what that could be. What do we people need to see? Can they have some first loss that comes in from someone else. We can get into all kinds of design, right? But I think these are the things that we need to start thinking about, having conversations with. We're sitting with funders and who are thinking about like blended finance or first loss. It's like, okay, would you do that for a debt provider? Then it's up to us investors to make sure that our early stage investments are disciplined and are tracking their financials well, and so they can go to these people and really unlock that debt quickly, right? So I think a lot of people have different roles to play in that. But I will say, like, I think when you look for examples, if you go pre-Series A, they become less and less. It's tough. And then you start getting to grants, and even that's tough. The grant cycles are long. So I don't want to just say, like, that, yes, Nairobi is an unbelievable, and the content is becoming an unbelievable dynamic ecosystem, but we do want to, there are areas of improvement, as one would say in OKRs.
Can I just double click on the comments there? Because if we start to get deeper into that early stage, so what does that look like? And I think we do need to start having some panels on the best kind of funding to bring into your early stage company is sales. So revenue. And I know it's hard, but I always come back to the idea that as a startup, when you solve a hard problem, when you really understand a customer problem and you sell them a product, that's the most critical thing in your business. If you do that, and you do it with some level of traction and some level of fidelity, the equity will come, the debt will come, things will come. So at the early stages in this kind of bootstrapped, like, and as founders, yeah, you got to throw some money in or you have to put your time in. The two most important pieces of capital, I think, before you actually take investor money, which everyone should remember is a big deal. Like looking someone in the eye and saying, I'm going to take some money from you and do my best to make it valuable is really important, are sales, or at least some level of customer traction, and I think human capital. So at Holocene, we throw, our portfolio companies can attest, a little bit of cash and a lot of hard work with our companies. I know Delta 40's here, Catalyst is supporting the event today. The most active early stage investors in Africa at this point are venture builders and studios. That's because human capital is necessary. So I want to put it back and say, before you go ask these guys for debt or for equity, sell a product and get some support from some human capital providers. And ideally, grants can assist that as well.
And I'll just add to that. That is actually literally our approach as an early stage investor. We know that we'll have to, we should not have to. It's the right thing to do is to have an infrastructure around our portfolio companies on a variety of areas that one may need. And the earlier you go, the earlier it's around customer insights, around product, especially if you're going to deep tech or clever tech, right? So Aisha and I were just talking about that just seconds ago before this panel. It's like, I think this is the areas where investors or equity investors can take on some. Of course, that means then you look at the unit economics of a fund, especially when you, this is weird, right? That's hard, and then that's where you have to go to LPs and others and train them that we actually, to really build sustainable, scalable, and give the support, we're gonna need more money than just what VC economics showed in America, right? And this is a hard conversation that is starting to happen on the corners of these places, but it's not happening in the middle, which is where we need to happen.
David, I'm trying to read your face. I'm not sure if you agree or disagree. What's happening?
No, I had a question. So I've been at 6 or 7 workshops this year where we've been talking about some of climate tech or ag tech or even ocean technologies, and in most of those workshops, the early stage venture builders, the startups have said the VC model is not appropriate. And I think part of the reason that we're having this discussion is because we're starting to look at other type of models that are more appropriate within the climate tech, ag tech, blue tech, harder kind of spaces. And I'm wondering, well then, what is the role of venture capital in that space? And does it have a role to play, and where does it fit in? I'd be really keen to hear from you guys on that as well. I think Hetal and Josh, where you guys have had quite a bit of kind of exposure to that.
Who wants to go first, Hetal?
Sure. You're setting me up to be New York cynical. No, I firmly believe venture capital does have a role. I also believe that the hype of venture capital over the last 5 years, especially on the continent, distorted what it is as an investment tool. It is a high-risk investment tool for innovative, high-risk testing of business models, scalable business models. It does not need to be the only investment tool. It should not be the only investment tool that helps us build our communities in the global south. If that's what we think, then we are failing ourselves and founders in the communities and in the ecosystems and the places we want to build. We need to have other tools, which includes debt, et cetera. I think we need tons of low PE, like, you know, small investor PE where local money can come in and invest in local businesses that'll have maybe in a year or two they'll be EBITDA positive, start paying you back, et cetera, right? We need all these tools. So I think VC's role, to me, going back to your question, is that it can take on what could scale that could be a higher risk. So when you start talking about climate, deep tech, those are areas that I think small cap PE, what I just described, will not take on, right? Because they may not see a return ever, or at least for 6 or 7 or 8 years. So I think it has this very specific role, but the hype of the Valley has brought all in, we all thought in the founders thought that's what it's supposed to be. And then we had our tourist VCs coming in, so people thought that is how it's going to be. And now they're all gone and we're still here. So what are we going to build?
Josh, your take, and then Sebastian will come to you, and then we'll open the floor for questions.
Yeah, I couldn't agree more. And remember, if you're an entrepreneur looking for VC capital, remember VCs have bosses as well. It's called an LP. And those LPs are saying, you need to get me these returns. And raising a fund is super hard. So if you think fundraising for your startup is hard, raising a fund in this environment for a non-on-the-run sector is very, very difficult. So respect the fact that they have a hard road to walk as well. But what needs to happen for VCs is they need to get leverage, right? So your $100,000 of equity needs to be worth $1 million of capital. So all of a sudden, if you have grant capital and debt, the equity becomes higher leverage. For entrepreneurs, you need additional runway. You need to be able, so if you don't know what a weighted average cost of capital is, go home and Google that today and figure out, if I only sell equity, it's very expensive. If I can then bring in some debt and some grants, that brings down the cost of capital for my company. Super, super important things to remember. And I want to say, like, this is I'm building Holocene is my 8th startup. I've been doing startups for a long time. I started in California, came over to Nairobi, and now I'm down in South Africa. And through my journey, I can say the first business that I've built that was cash flow positive was in South Africa. Why? There's no funding. I didn't have another option. I had to build a cash flow positive business. Everywhere else, you can raise 30 million bucks on a dream and some nice pitch decks. Even in Nairobi, that's a thing. Like, you can raise a bunch of money on a cool idea, believe it or not. South Africa, good luck. So build great businesses and the cash will come, I think is really, really important. Great businesses solve hard customer problems.
Ethel?
I was just going to say, my colleague Natalie is here, who's going to be on the next panel, and can tell you about that for Latin America, which is, again, very similar and very different. And you have to get way more revenue positive and EBITDA positive much earlier.
Sebastian, before we go to questions, so it's clear we're dealing with an evolving funding landscape, changing role of internal financing, external financing, debt, equity financing. How does this impact green innovation in Africa? You know, if you had to flip, what's the effect of all of this change on green innovation in Africa?
Yeah, sorry. Okay, good. Well, I think, look, I think the changing funding landscape, I think we're really talking about changing funding landscape. I think we look at the global funding landscape has changed. Capital is more expensive, and investors and investees alike have less margin for error. So everybody has to be a lot more focused. Everybody has to be a lot more commercial these days. The times of free money are over, and that's the message that you're hearing every day on the news. But that's the reality for investors as well. So I think it's just there's capital available. There's plenty of interest. There's plenty of interest in this space. But again, it's just to be a little bit more focused and disciplined, and it behooves us all.
Let's open the floor for some questions and comments. If we could get a microphone over there.
All right, you have a question there?
Maybe just a short introduction before your question or comment.
Sure. Hi, good afternoon. I'm Melanie Keita. I'm the co-founder and CEO of Melanin Capital. We're a climate fintech platform providing green loans and carbon credits for SMEs. Thanks for this panel and the great insights and discussions. I have a question on the events that we managed to get debt and your perspective on the cost of debt for climate fintech like us. We just happened to have a discussion on a transaction where we're looking at around 35% on the Kenya shillings with 2 years and a demand on security. So how do you see the evolvement of the debt landscape for startups like us, and how do we design debt instruments that can be deployed at scale so that we can foster more climate lending? Thank you.
Who wants to take that question? Sebastian?
Yeah, happy to. Well, yeah, first of all, yeah, I saw your presentation earlier as well, and I'm actually quite interested in your model, so maybe we can chat a little bit more about that afterwards. But yes, overall, I think, look, I mean, it's always going to be difficult at the stage that you are at right now, this early stage, to raise debt is always going to, once you need to get to a kind of critical mass there, once you actually have a bit of a balance sheet or a track record, and or you have something that a bank or lender can identify as some form of security, And again, it's going to be very difficult. And of course, the pricing that you're receiving is just a function of the perceived risk and maybe some opportunism, who knows. But the thing is that, so again, as we discussed earlier, I think that, sometimes there are probably more appropriate, types of funding that will get you where you need to get. Maybe the first $500,000, $1 million will come from other types of concessional financing. You also just have to be aware of, at the end of the day, if your unit economics, for example, can actually absorb that high cost of funding, then perhaps that kind of deal makes sense for you. But again, everything is very particular to that, to your specific case, and you know best, really. I think once you get to that kind of, $2 million plus kind of balance sheet and a little bit more track record, you'll be able to access a lot more, lenders, impact lenders, and also more kind of scaled forms of capital. The good thing about debt, once you get to that level, that it's endlessly customizable. The process, it's more rigorous, there'll be a lot more questions asked, but you'll find that debt providers can actually structure something around your business that works for you and works for the lender as well.
Maybe just add, because I worked in Pego Solar for a long time. We brought on a lot of debt funding. And I think it'd be helpful even for Seb to tell the entrepreneurs, if you're early, what can I do today to make me debt ready? So if you don't have great financial accounts, if you don't know where your assets are, if you don't have a really clean warehouse, I'm not saying you don't, I'm saying you plural. Like, what do you need? If someone comes to you and says, hey, I want $1 million of debt, what kind of things do you need to see in order to be able to make that type of transaction?
Well, yeah, exactly. So first of all, when we're talking about fintechs or lenders in the first place, I would expect you to have already invested your money, in taking the risk that you want. You can't be a lender or a fintech without, using your own money. So that's the first thing. And then, of course, it's just the kind of scale, to make it work for us, transaction size. So that's just a question of what type of lender you're speaking to. But of course, the data that you have, we're a data-driven, lender. So the thing is that we integrate with our investees, and we want to see pretty clean data, and then we do a historical analysis. So that's really important. Financial reporting, of course, extremely important. Having a competent chief financial officer always helps. And then, of course, the general management team, and of course, being able to think about the risks, because the risks, to debt providers are very different, maybe perhaps to sometimes equity providers. Like we're thinking about macro risk, we're thinking about currency risk, and having thought about that, or is extremely important. And then the most fundamental, I guess, is of course, do the unit economics work? And I think that's always a persistent question, for example, in pay-as-you-go solar. But I think that the unit economics need to be able to absorb the cost of funding fundamentally, and that's something really important.
So we've run out of time, but I'm going to give 30 seconds to Hettel and David, perhaps as a parting shot. Your takeaway.
Yeah, I think it's really exciting, as Hettel was actually saying. I think he said it exactly earlier, which is this, if we're only relying on VC as the only instrument to build innovations in Africa, we're doing ourselves a disservice. And I think what would be amazing for this conference to continue to create space to invite other types of funding institutions and other types of businesses to start bridging this gap. Because I think it's not just about the capital stack within rounds, but it's across rounds, and looking at how we support and grow businesses, from the work that Josh and Venture Builders are doing with human capital, to the work that Seb and Co are doing in addressing financing at later stages or at the middle stage for debt financing, and the work that Hettel and organizations like himself are doing in terms of supporting with venture capital. And I think that's a really exciting space, and I don't think it's something we should see as a lost. I think it's something we should see as an opportunity with this downturn to really innovate on.
Hettel?
I actually don't have much more to add. We can have that as the parting shot. If there's any other questions, I'm happy to answer. We can meet after, but I think go for it.
I'm afraid we have to. ended there. We've run out of time, unfortunately. But
Can I take 10 seconds from Heddle?
Taking 10
All right, cool.
seconds.
So the same way really good startups do customer discovery with their customers to figure out the customer problem and they sell them a product. If you're an entrepreneur, do customer discovery with your investors. So go out and talk to these guys and talk to a debt investor in an open conversation and say, hey, like, how does this thing work? Like, you don't have to always be on. How does this thing work? What does your equity returns look like? Like, you're selling shares or selling products, do customer discovery on both sides to understand how those teams work and think. And we're all happy to do that. I think we'd be happy to sit down with any startup and say, here's how debt works, here's how equity works, here's the key things we think about. It's really, really important in this ecosystem.
Yeah, actually, that reminds me of a party strategy. It's like really find investors who are willing to do that with you, and it'll be much easier when times get tough, because we know that they're going to, and we know we need to build together. And I think being able to have an open space, if it doesn't fit, it's okay. I mean, it may not be fit in my mandate. We'll try to find you someone else. I think these are the type of investors you want to get around you, who'll help learn. We want to learn from what you're thinking about as founders, because we're not that close. So it's an education both ways. It's not like, oh, we're just feeling that we're giving or being taken from. So I think those types of relationships really will go a long way also in helping shape how you want to, what you're building and what the unit economics will in the end be when you approach Series A or SEB.
Thank you so much, Hetal Patel, Sebastian Romisches, Sebastian Wichmann Rogers, Joshua Romische, and David Saunders. Thanks for your time.
And thank you, Mr. Prince, for all of that. Thank you, gentlemen. Super highly appreciated. Very, very meaningful. Walk around, get cards, talk to them, send them things. Just get to know what's going on.